We begin this program with the big issue. Bonds rallying, stocks resilient. Something has to give.
This is a debate that has been going on for a long time.
You can't have your cake and eat it too all the time.
Equities going up, bonds going up.
There has been a huge gap also between the bond market and the equity markets.
Inconsistency in the equity market right now relative to the bond market.
They're discounting a different growth scenario.
One of the two markets must have it wrong.
The equity market is pricing in not only easier policy with a higher valuation multiple, but absolutely pricing in a recovery in earnings.
The bond market says, wait a minute, with this flatter yield curve, the recession is going to happen anytime soon.
How do you get a recovery in earnings without a recovery in global economic growth that keeps the Fed on hold without easing?
We think bonds are going to give.
But ultimately, you do have a day of reckoning where you have to right-size expectations.
To explore the question, joining me around the table here in New York is David Bailin, Citi Private Bank CIO, Mike Schumacher, Wells Fargo Securities Managing Director and Head of Rate Strategy, and Bloomberg's Lisa Abramowicz rounding things out for us here in New York. Let's begin with the premise of the question. Does something have to give? We've seen this before, where bond markets can rally, global bond markets can do well, risk assets can do well too. Why is this time different if it is?
Here's my question. They can rally together. It's not necessarily incoherent for them to rally, as we have seen in the era of quantitative easing. The question is, for how long? At what point does something have to give? And when I talk with people, it seems like increasingly there is this idea perhaps they could continue rallying together, or bond yields could stay this low and stocks could continue to gain for another 6 months, maybe 8 months. But that is sort of when you'll start to see some of the tensions pick up.
What do you think, David?
I think that's exactly right, because what we're talking about now is a very late stage in the economic cycle. So what the bond market is, in my mind, it's always right. It's a question of when it's right. It's telling you that you're looking at 10 years that we're going to be entering a period of significantly lower growth, and with that lower growth, we're going to eventually see a recession. It's something that you can put off forever. But in a late stage where we are right now, and we sort of divided the market up into these, you can see significant equity gains between now and that time. And that's why market timing is such a dangerous thing. And I think investors should expect that your equities are going to do well for a period of time. And then we're going to enter into a recession where we're going to have to deal with the fact that there is no stimulus in the United States and that growth is going to slow. And there's going to simply be a correction, and it's going to be a material one, unlike the scares that have happened in 2016 and 2018.
Mike Schumacher?
Normally, I'd say the bond market's got it right, of course. Not today. The bond market's delusional. It's pricing 30 basis points of easing this year by the Fed. That doesn't make any sense. I mean, if you look at the dots, they'll tell you flat to maybe hikes. How is the bond market getting 30 basis points of cuts? Seems like it's way too much, way too quickly.
What about Steve Moore?
Something that also doesn't make any sense.